wants to talk about this year's best performing S&P 500 industry sector? I do, and apparently you do too. Today's showdown is an audience-requested triple header between three ETFs in the red-hot energy sector. We've got ETFs from VanEck, USCF Investments, and State Street Global going head-to-head. So which is the best way to invest in the energy sector? Find out right after this. I'm Ron DeLegge. You're watching ETF Battles, and we're glad to have you along for the ride. Now, this is a weekly program where we curate audience-requested ETF matchups from you. Then we tell you which ETFs are the winners based upon the analysis from our judges. Now, I glanced the other day at Berkshire Hathaway's portfolio, and aside from banking and financial services companies, oil and energy is among the more prominent investing themes. So those of you already invested in or interested in investing in the energy sector, well, you're in good company. Today's ETF battle was requested by a viewer by the name of Frank. He wanted to see these three energy ETFs compared and contrasted. We've got XLE from State Street Global, OIH from VanEck, and USO from USCF Investments. XLE and OIH, by the way, are invested in oil and energy related stocks, which is quite different, as you're about to see, from USO, which uses crude oil futures contracts to get its energy exposure. Judging today's triple header is Dave Kreinces with ETF Portfolio Management and Cinthia Murphy with the ETF Think Tank. It's great to see both of you. Welcome back to ETF Battles.
Hey guys, good to see you.
Hey Ron, Cinthia, nice to see you guys. Let's battle.
So our four battle categories are cost, exposure, strategy, performance, and mystery. I've got the scorekeeping duties, and at the end of the program, we'll declare an overall winner based upon the analysis provided by our judges. Now, keep in mind, none of the battle outcomes are ever predetermined or known in advance by myself or any of our judges. So let's get started with the first category, cost. Cinthia, kick things off.
So we're going to have to go at face value cost to just lowest cost would be XLE. It's less than half the cost of OIH, is a fraction of the cost of USO. It's liquid. It trades a lot. It trades at narrow spreads. It's just overall the cost winner here. Now, I would just add that, like to your point earlier in the intro, these funds are extremely different. So OIH is more of a thematic energy ETF for thematic funds. It's also very competitively priced. So, but face-to-face, XLE has the lowest price tag, so he wins here.
Thank you, Cinthia. Dave, you're up next. How do you see it in terms of cost?
On cost, the current historic decline in stocks and bonds together reminds investors that cost is often not a material factor when investing in ETFs. That said, the expense ratio for these funds ranges from 0.1 to 0.8%. And you could easily give the cost win here to XLE, although given the volatility of these securities, the cost difference is just not material. So I call the cost a split decision.
That takes us next to exposure strategy. Dave, you're up. Give us your analysis.
For exposure, XLE has roughly 40% in Exxon and Chevron, while oil services OIH gives you over 30% in Schlumberger and Halliburton. And the United States Oil Fund, USO, is a strategy to target oil prices with a K1 for tax purposes. Between these three energy funds, I give the win to XLE in favor of extra large cap exposure and no K1.
Thank you, Dave. Cinthia, you're up next. How do you see it in terms of exposure strategy?
Yeah, I agree with everything Dave just said. It's, goes back to how different these funds really are. I mean, there really is XLE, which is, none of these funds are particularly poster children for diversification. XLE is very concentrated, OIH is very concentrated, and USO is a futures fund. So you are not getting diversification with any of these ETFs. XLE is particularly concentrated, but it's only has about a 10% allocation to oil services. So it's more broadly diversified across the energy sector, where OIH, it is just oil services companies. So if that's your space, that's way more bang for your buck in terms of oil services. And futures are futures. It's not for everyone. So I like the XLE slightly more diversified because the energy story is not just oil. There's more to it. So I think XLE gives better exposure for the average investor.
So our judges agreed on exposure strategy. Will they agree on performance? Cinthia, you're still up. Give us your take.
Actually, performance, these three ETFs, if you look year to date, it all goes to time frame. Year to date, all three of them have done incredibly well. You would not have lost money with any of them, would win big, as in more than 40% big year to date. I think however, you see in oil services, it's been a slowdown in that momentum in the last month. So that performance, OIH was outperforming XLE until the beginning of this month, and now it's really kind of slowed down and it's below XLE year to date. So I think the performance momentum has left the services sector for the moment. So I'm going to give it to XLE.
Dave, performance is the next category for you. Do you agree with Cynthia's analysis?
On performance, this data shows the past decade was dominated by technology, although the short term has strongly favored energy. Early this year, we did a few videos in ETF Battles reporting the need to shift from technology to cash and energy. And this chart shows over the past 17 months, including last year, the unleveraged energy sector XLE returned 127%, while the S&P returned just 6%. And the 2x energy wildcard, symbol ERX, delivered 342%. However, the current environment is still too volatile for leverage, so I give the performance win to XLE once again for better long-term return among unleveraged energy choices. And that said, investors should also note that leveraged ETFs can be important tools for enhancing cash management, tax efficiency, and hedging long exposure without adding portfolio leverage. Just go to Amazon and read the third edition of our book, Investable Benchmarks.
That takes us next to the mystery battle category. This is where our judges can pick a single factor or multiple factors that they think are crucial to today's showdown. So, Dave, what is your mystery battle category and who wins it?
Well, guys, my mystery category is always position weighting. And the mystery here is the actual percentage allocation in each security. At ETF PM, our active tactical strategies could allocate up to 30% exposure in each of these funds. So I call the position weighting category another split decision.
Between which funds?
All three. It's a split decision. We could put up to 30% exposure into any of them.
Excellent. Thank you, Dave, for that clarification. Cinthia, you're up next. What is your mystery battle category and who wins it?
So I really struggle with a mystery here because it's these funds are so different. So I just went with the macro environment and the whole inflation story as it relates to oil. If you are, I'm assuming we're talking about this today because a lot of people have looked to play oil as an inflation hedge, as a beneficiary to inflation, and because prices have been going up in oil. And so in that story, you have three very different ways to play it here. You have your futures market, which is, not spot oil prices, it's futures prices. And that curve is in backwardation right now. So it's a good thing for investors. You're not paying roll costs, but it also suggests that, at least in the futures market, they see oil prices lower down the stream. You could play the oil services sector, OIH, which is a really concentrated play. It really gives you solid exposure. Does a great job exposing you to oil services. But oil services are a part of the oil industry that does well when oil prices are going up. When oil prices go down, then you're better off holding on refiners, like an ETF like crack, for example. So if you think, inflation is going to keep going up and oil prices are going to keep going up, oil refiners are going to give you that extra performance relative to a broader energy ETF like XLE. Now, if you are nervous that maybe prices are going to moderate here. Maybe the Fed's going to succeed into, reeling in inflation and slowing down the economy, which is going to impact oil prices, pressure it. Maybe you're better off in XLE because then you're really concentrated on your big integrated companies like Chevron and Exxon, which benefit, throughout the entire oil industry. They're involved with every part of this industry. So they're less vulnerable to to big fluctuations in the oil market. So, it's the mystery category is what's your outlook on inflation and what do you do from here? And it's actually a split decision because it depends on what you think. I try to find a consensus on it, and depend on who you read. There's so much divergence in outlooks. I'm not going to pretend to guess what happens next. So it really is a split decision because they each are going to give you a different performance relative to what happens next.
All right, let's give our judges a final opportunity to give us their overall battle winner. Let's start with you, Cinthia.
I hate to just say XLE because that's the sector spider. It's the everyone's energy fund. It feels too vanilla to be exciting. But I think, it is really cheap. And today's point, cost doesn't matter. I'm a big believer that costs matter. At the end of the day, the more you pay, the less you keep. So given the amount of uncertainty out there, the complexity of futures market, and the fact that if oil prices decline, oil services companies are going to be in the line, they're going to be hit. I think XLE gives you a more diversified exposure that may cushion you a little bit from the unexpected in the energy space. So I would pick XLE.
Thank you, Cinthia. Dave, your final opportunity to give us your battle winner.
I agree with Cinthia, costs matter, but, value and total return are the more important factors. And to recap this energy sector melt up, we believe investors should be extra cautious. Principal protection always comes first. Technology and long-term treasury bonds have been crashing. And the wildly successful risk parity strategy of the past decade, which enabled the use of moderate leverage, is now proving to be more dangerous than expected. This means additional deleveraging may be a headwind that is gradually getting priced into the market. Still, I give the energy battle win to XLE, and ETF PM has been cautiously trading long positions in XLE.
Well, thank you, judges. According to my battle scorecard, this is a win for XLE, and our judges highlighted what they liked about this fund. They agreed in terms of exposure strategy, performance. They also agreed on the overall battle winner. And then some points that they made in terms of understanding the differences between these strategies. Of course, XLE is going to just track those energy stocks inside the S&P 500. OIH is a more concentrated play on the producers. And then USO is an even more concentrated play on crude oil itself. And so these ETFs are very different from each other, but again, how you use them inside your portfolio will depend a lot on your personal preferences and also your outlook. Judges, outstanding job breaking down today's energy melt up. It was fun. Good job.
Thanks, Ron. Always a pleasure.
Thanks. Always great to see you guys.
Be sure to visit the description section below for research links to our judges. While you're there, you'll also see our viewer resources section. We've got online classes, tools, and we also have a weekly ETF newsletter. Also, be sure to subscribe to ETF Guide TV and hit the like button if you've been enjoying our programs. Which ETF battles would you like to see in our next episode? Post your ETF ticker symbols in the YouTube comments section below, or hit us up on Twitter at ETF Guide. If we choose your battle, you'll win your choice of an ETF battle shirt or coffee mug. I'm Ron DeLegge. Thanks for watching. We'll see you next time.